I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
As you work with people who invest, what are the elements that make them attractive to you guys and returning customers, I guess?
Yeah, I think it's a very hands-on experience. I mean, the exempt market, the market we're in, the real estate private equity space, the syndication space, it is somewhat hands-on unless it gets a much larger company. So people are dealing with principals in most cases, where you don't have that in the equities or other types of investment REITs and what have you. You're not sure what you're investing in or who's handling your funds, where with us, you're dealing with, in our case, with our CEO, and understanding really the investor profile, the investor psychology of what are they looking for, and allowing them to kind of speak their part.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. It's one of our Ask the Expert episodes. We got two great people on the line with us right now. We got August Biniaz and Ronnie Gou. And so, August, as tradition on the podcast, you're the experienced investor, so you're up first. So first of all, welcome to the show. I'm glad to have you.
Absolutely, man. This is a long time coming. I've been watching you grow, and we've been watching you on LinkedIn. So excited to be here today. I'm humbled to be here to answer some questions. I'm sure Ronnie has some pointers for me as well. And I'm sure you have, with your expertise, you'll add a lot of value as well. So excited to be here today.
Thanks a lot. And Ronnie is probably the most experienced aspiring investor we've ever had on the show. And Ronnie, first of all, my hat's off to you for the humility and the desire to learn from people who are more experienced. But we'll talk a lot about that later. But excited to talk with you as well. But that said, August, back to you. Tell us a little bit about yourself. Give us an idea of your background, where you come from, and how you got into apartment investing.
Absolutely. Yeah. My background really started in real estate 16 years ago as a licensed agent. Mm-hmm. I wasn't really good at being a real estate agent, but I was good at finding deals. Mm-hmm. So I started doing small fix and flips, eventually started my own general contracting company. I was pretty good at managing and finding deals. Mm-hmm. My general contracting company, I was building single family homes, more on the luxury side. And eventually always wanted to scale, and eventually got into ground up development projects. Mm-hmm. Now, when I did my first ground up development project, I realized that as the GC, I couldn't be overseeing that construction project where I was doing it on single family. Mm-hmm. That I had to bring on a GC that had expertise in doing multifamily. And that's when I had the deal. I had the investors, and I myself was one of the investors as well. And I then brought in the experts. So I syndicated my first deal without even knowing what syndication was. And I fell in love with that model. Now, when I was doing single family, it was also similar to that as well, where I would find a piece of land. I would go to friends, family, business associates and say, hey, I'm going to be the builder on this project. I've built many single family homes. Let's pool our capital and build this single family project. For multifamily was a similar thing, but then I had to bring on the GC and other experts, and I fell in love with that model. I'm like, hey, this is what I want to do. I want to kind of merge the world of private equity and real estate and do ground up development project. That was kind of my dream. Mm-hmm. Soon realized that ground up development is not as glamorous as is made to seem, particularly in the region you're in. I'm in the west coast of Canada and Vancouver, and there's a lot of bureaucracy with the city hall. There's rezoning, as you guys call it in the US, entitlement. Mm-hmm. And that could be a very costly, difficult process. At times, it could take a couple of years to get a land entitled. And then when the construction begins, you have environmental issues. When demolition takes place, that could run up the cost. And then when construction takes place, you have issues with cost overruns, material cost, contractor cost, and other issues. And by the time a project is finalized and is ready to be marketed and sold, all the performance you did on day one could be completely different. Yeah. So when I was in that stage of trying to grow my my ground up development kind of syndicated investment, where I was introduced to the U.S., and what I noticed is, you know, a lot of groups, rather than doing ground up development, they were buying already built apartment buildings. They were doing some small renovation, selling these things in 3 to 5 years. But what was shocking to me was that they had cash flow. I'm like, how is this possible? How are these guys getting cash flow? How much are they putting down? And I realized, no, they're doing a conventional mortgage. They're putting down 20%, 30%, but they're still cash flowing. And that was surprising to me, because the region I'm in, I'm at a 2%, we're at a 2% cap rate.
Ooh, wow.
We're in negative cash flows, similar to California and New York. So then I fell in love with the model. What also made me really fall in love with the model was how the alignment for the investor interest existed within this deal. As a general contractor, as a builder, as a real estate agent, I got paid no matter what happened with the project. My compensation wasn't performance based, but I realized in the syndication, multifamily syndication business, and real estate private equity, the majority of the profits are made on the back end. And when there's preferred returns, that the investors need to hit those returns before the GP participates. So I fell in love with that part of it as well, and co-founded CPI Capital a couple of years ago, and we're here today.
Nice. Yeah, I love that. You know, you're able to basically grow organically, and you're doing syndications before, you know, you really knew what that was. Something I learned a long time ago, you know, long before I heard the syndication term, was the OPM term, you know, the other people's money term, and do as much as you can earning or using other people's money, and, you know, finding that win-win situation. It sounds like you've been doing that for most of your career. You know, and I assume to be as successful as you have, you had to figure out a way to make it worth your investors' while to begin with.
To be totally transparent, I didn't realize that saying. I never pursued the idea of private capital. It was more just going to my friends and family, and I struggled for a long time having incredible deals come across my desk, knowing that I could jump on this deal, build it myself, bring on the contractors, tremendous deals, and just not having access to equity to be able to do it. So it was a frustration that was within me for many years before realizing that there was a process where you could raise capital. Again, the market I was in was Canada, so it wasn't as common. Syndication wasn't as common as it is in the US where I was located. So it was a frustration that was built up. So the moment that I realized there is a possibility to achieve, what I was looking to do through raising private capital, and there's a process in place, and so on and so forth. I can touch on that more, and what the direction we took when we realized that there is a possibility. So yeah, it wasn't. I came to that realization later on in my career as a builder.
So something I like to focus on are the kind of the inflection points. You know, what was it that helped you to realize that you could, you know, use that model and raise private capital?
Yeah, I think it was the first deal. It was the first multifamily large deal that I had. It was a land assembly, as we call it, putting 5 single family lots together, going through the city and doing a rezoning. And when I put those projects under contract, and I approached some investors, it was shocking that how investors came on. No, it was a JV. It wasn't a passive investment like a limited partnership or LLC. It was a JV. But I ended up raising $5 million in 2 weeks. And some of these investors I'd never had contact with before. I had one associate who knew them, and they jumped on. My associate invested. I invested in it myself as well. So it grew rapidly, and it showed me the potential that exists. As long as you have a great deal, as long as you have the experience and background, investors are open to invest. And that was an idea that prior to that deal didn't really exist in my mind. I had set limitations in my own mind, saying that, hey, if I can't get approved for this mortgage, or if I don't have the equity, I can't do the deal. And this deal proved me otherwise, and really catapulted me in this space of real estate private equity.
Nice. Now, something else that I want to focus on, and another inflection point that you meant is your transition from Canadian real estate to U.S. real estate. You know, what kind of prompted that, and what difficulties did you have, making the jump? I mean, there's an imaginary line along a parallel, but it makes so much difference. But what challenges did you have jumping across that line?
The biggest challenge was going to my mom and saying that instead of building single family and multifamily, I'm going to be buying properties in the U.S. I think that was the big number one challenge, and she was on my case. But really, what it was yields. I mean, U.S. You got over 300 million people. You got a very entrepreneurial, positive country. There's the yields are just there. The opportunities exist. The rent to value ratios, really, the rental yields compared to my region. So I saw the potential. I also saw the trajectory and the growth of other companies that were Canadian companies who had invested in the U.S. And the farther research I did, I realized that this is happening on the institutional side as well. The Canadian Pension Fund, which is one of the largest pension funds, partnered with Greystar to purchase and build multifamily. So I'm like, hey, there are billions of dollars of Canadian capital is going to the U.S., both on the retail and institutional side. So there must be something greater on the U.S. And when I just did the numbers, and the culture is a bit different. In Canada, it's the appreciation game that people play. In the U.S., you got the cash flow appreciation, and with multifamily, you got the opportunity to go and force appreciate, which has the trifecta.
Yeah. And you mentioning that you guys were at a 2 cap in Canada, we complain when things are trading at 3 caps here now, because, a couple of years ago, I think the average cap rate in the US was a 6, I think that's dropped down into the high 4s now, according to last reports I've read, but there's good and bad to that. The forced appreciation at a lower cap rate, you get more, bang for your renovation buck, but sure makes things expensive buying, and it reduces the cash flow a lot. So
yeah, just one more item to quickly add, Brian, is also Canada is not really entrepreneurial minded. So we do have a lot of restrictions when it comes to growth and what have you. We're very highly taxed. Also, another item when it comes to multifamily, we have strict rent control laws across Canada. So I had somebody on our YouTube show, a multifamily, and I was making the comparison between Canadian multifamily and US multifamily. And in one of his in one of his ways that he was trying to promote Canadian multifamily, he's like, hey, we just paid one of the tenants $20,000 to move out, and that was it. They moved out. I'm like, if my American associates hear about you pay $20,000 just to have a tenant move out, it will totally shock them. So yeah, the rent control laws are very restrictive here as well. So that's another great thing about the U.S. in most regions in the U.S. I wouldn't say everywhere, but yeah, I just want to make that point quickly.
Yeah, and that's a good point to make. I mean, like I said, that line in the sand, or I guess the trees, but a lot of difference when you cross lines and go into different jurisdictions. And I know a lot of the investors, a lot of people who are GPs on properties don't want to see those rent control laws become the norm here in the U.S. I know there's a lot of jurisdictions that do have them, and there's a lot of people who are very reluctant to invest. So it's one of those two-edged sword where it's good for some people, not good for others. The age-old distinction. What's better? The community or the individual. And I think the U.S. in most of its laws has chosen the individual. So,
yep, data shows that rent control it ruins business and commerce. So I've done actually a video on this with a experienced property manager for 30 years in Vancouver who went through the process of rent control coming in, and he showed how that was the reason for a lot of things to go wrong, including supply, that developers were just not building a market rental because there was no point, because of the situation that exists. So there's a lot of data and research on the topic.
Absolutely. Something I always like to ask people is about their big burning why, their motivation for being successful. So what is your big burning why?
Yeah, before the show, I was doing some research and I binge watched a few of your shows. So I knew this question was coming up, and I reflected on it. I'm like trying to come up with the best answer, but I kind of asked the question for myself, and I pondered about it for the last few days of what is my why. And I can't say it's one reason. I can't say it's financial or personal or altruistic. It's more a combination of all. I think number one is the ability to be able to create jobs, for masses of people. I look at multifamily as a win-win-win business. There's, the tenants, the people living in these communities that we buy are winning because we go in and our business model is literally to value add. The people who get jobs from the renovation and management and the private equity firms that creates jobs, they're winning, and also the investors are winning as well. So I want to be able to, my why is to creating those jobs, creating commerce, creating business, creating returns for investors. Also on a personal level, my why is being a successful businessman for my family, for them to be able to live a comfortable life and be given things that maybe I wasn't, or the advice that I wasn't given when I was growing up. So that's kind of my why all in one.
I mean, it sounds like you just want to help the most people possible is kind of what that is. I mean, you're looking for the win-win-win situations where everybody benefits, and in an effort to make people's lives better, including yours and your families. So
absolutely.
Yeah. Thanks for giving us a little, window into your soul for a second. But shifting gears one more time, let's talk about one of the deals or projects you've done in the apartment investing space. So, pick your first, your favorite, your most recent, and give us an idea of how it went down.
Absolutely. It's going to be a bit of a long answer, but I'll try to run through it. I do speak a bit fast, so if anybody is listening to this on 1.5x, it might be too fast for them, but
go back down to 1.2 or something, right?
Exactly. So I'll be quick. I mean, when we first started out and saw the potential in the US, we're like, okay, this is the asset class. This is the property type we want to focus on. This is the business model, multifamily, class A, class B, value add, and it's got to be institutional. The issue there was equity. Like, how are we going to be able to buy a 100+ unit asset, which is class A, class B in these high growth areas? And we're going to need access to a large amount of equity, and being a newer firm, that was going to be a difficult process for us. And there was so much of our time. Initially, when we started CPI with my partner, I was under the impression that people that I had made a lot of money over the years, for millions in some cases, they were just going to jump on and invest with us. That transition wasn't as fast as I expected it to be. So calling, an associate saying, "Hey, we done a deal together. You made a couple $1 million on a few houses I've built for you. I got a deal in Orlando. Would you want to jump on and invest $100K?" It wasn't as easy as I thought because of the US, because of this GPLP structure.
Yeah.
So we came to a realization early on that, hey, we're going to need access to a lot of equity, and not just for one deal. If this is a repeatable, scalable business model, we're going to need a machine that's continuously going to be building, our investor pool. And that's when we came to kind of the strategy to become thought leaders within the space, that there was somewhat of a vacuum when it came to Canadians investing in the US, when it came to this kind of cross-border investments. And we started building a brand. So we built a brand around CPI, around myself, around my partner, Ava Benesaki. And with our YouTube show, with our newsletters, creating a lot of content, webinars. Ava wrote a book about real estate investing in the last couple of years, and it just attempting to become thought leaders. We've spoken on over 70 podcasts and YouTube shows, spoken on multiple summits. So we've built that brand strong enough that if you Google Canadians investing in US multifamily, we'll show up somewhere there in the first page without any SEOs. So that assisted with that side. But then soon we realized so much of our time, the resources, is being spent on investor cultivation and nurture, that the deal side, the acquisition side, we're somewhat overextending ourselves. And that's when we realized that we need to go the co-syndication model, where we partner with our active operators as our asset manager on the US side. They act as our basically boots on the ground, and then we come on board as a partner. It was important for us to be the GP on deals, to have say, so we're not subordinate to anyone else. And through our fund of fund structure, our Canadian investors invest into our Canadian fund. Our Canadian fund invests into the US fund, and then our US investors can invest directly into the US fund. So that's kind of the long way. So our first deal was a deal in Orlando, Florida, with passive investing, Dan Hanford, and yeah, it was great. It was a great opportunity. It was a $92 million deal. It was over a $30 million equity raise. So for us to have that notch on our belt was amazing. Most people say start small, start with a fourplex. We started with a 350 unit building. So yeah, that's a little bit of background, long way of answering your question about our first deal.
I love it though. I love it. I mean, a lot of people, I think, put the cart before the horse, and there's a lot of educational programs that kind of point to, if you have a good deal, the money will come. And you guys came at it from the opposite direction, which I think's the more appropriate direction of, let's build this capital raising arm. Let's build this thought leadership. Let's build something, and then we'll start jumping into it, which I think for most people, the answer is start with a fourplex, but you guys built something that was able to, put millions of dollars into a large deal up front. So, there's good, better, and best ways to do it. I think you guys nailed the best. So,
yes. Just to add one quick thing to that is the other bonus of creating a brand and impressions are everything, right? The brand we created actually made us seem much larger, and I'll kind of get into that later on of people reaching out to me on top of deals coming my way. But it was deal flow. I had many operators reaching out. I had many brokers reaching out. So deal flow started coming in as well. So it wasn't just on building that brand, becoming a thought leader in the space, and a lot of people having the impression that we're bringing hundreds of millions of dollars of Canadian equity. Ended up having a lot of great deals coming our way. So then we could sit back and cherry pick the best deals for our investors. So just want to touch on that briefly.
Yeah, and that's absolutely true. I mean, a lot of companies, us included, we're sifting through deals as the broker gives them to us. In your position, you're looking at the deals that have been sifted through. You're looking at the operators that have looked through hundreds of deals to find the one.
Bottom of the funnel. We're bottom of the funnel. So they're looking at hundreds of deals.
And that's the great thing that you guys have built is now you have the track record, you have the experience, you have the ability to raise a lot of money. And so people, once they have deals, are coming to you with the good deals, and you're basically able to choose from the cream of the crop. So
exactly.
I think that's an amazing model. And eventually I want to be you, essentially, is what I'm saying. But
I'll add one brief thing, and forgive me every time I try to add, because there's some important points, is that within this co-GP partnership and structure, the question comes up always for the investor: hey, if I'm dealing with two GPs, does that mean that my returns are being depleted? But that's not the case. The GPs involved in a deal, there's certain allocations made to the GP to promote and the fees that just gets divided between the GP depending relative to their amount of allocation into the deal and their duties and responsibilities. The LPs don't end up receiving less returns just because there were more GPs involved. And the other great thing about it is there's more sets of eyes. There's us, our team, looking at a deal. So by the time that deal has been vetted by our operating partners, by the time it gets on our desk, we're looking at it. The brokers are looking at it. Our team is looking at it. By the time it gets to the investor, it's must be a phenomenal deal for that time.
Yeah. And one other thing, and I'm not I assume you're very aware of this, but if you're bringing in a large chunk of the capital on any deal, you can also negotiate better terms for your investors as well. So, as opposed to, a GP going out and raising, capital one investor at a time, if you're coming in with the SPV fund to fund model, and you're dropping in, 30, 40, 50% of the equity stack, you've got a little more bargaining power to get your investors maybe a little bit more, maybe a higher preferred return, maybe a little better split. So
100%, even if you bring in 10% of the total equity needed.
Yeah.
As long as that's kind of the perfect mark, is bringing 10%, at least 10% of the total equity needed.
Yep. So good. All right. Well, one last question for you. What's next?
What's next? Really, I mean, again, it goes back to building and scaling CPI. We were currently working with 15 or 16 virtual assistants from all over the world, marketing teams. We're looking to grow our team. We do have advisors and partners, but we're looking to grow our team, and that's basically the focus. Also, we would like to, initially when we did the co-syndication model, we did it out of need and not want. We did it because that's the way that we wanted to kind of get more deals. But we're realizing that's a pretty good model to have. So we would like to continue doing that model, but we also want to do our own deal as either the sole GP or the lead GP. So the next thing is hopefully in Q1 or Q2 of 2023 is to do our own deal as the lead GP, where we're bringing on other GPs to partner with us, or as the sole GP on a smaller deal. So that's next for CPI.
Yeah, yeah. And the nice thing about this, I'm sure you realize, is, you know, if you're not splitting the GP, you know, you do make, you know, more of the profit. You make all of the profits on the GP side.
Absolutely.
So there's a definite win there as well. And, you know, absolute, you know, best of luck to you. And I'm sure you guys are going to nail that with the track record that you guys have had. You know, I'm sure that I'll see plenty of deals like that come from CPI. That said, we're going to shift gears one more time, and we're going to bring Ronnie on the show. So Ronnie, welcome to the show.
Brian, thanks for having me, man. I appreciate it. I'm excited to be here.
Yeah. And, you know, I just got to throw in a plug for your wife, you know, Ronnie Gou. She's been on the show 3 times already, and she has 2 of the top 5 episodes, the #1 episode, and 3 of the top 10 episodes. So this is
big footprints, that's for sure.
Yeah, so. Anyway, Ronnie, thanks for coming on the show today. I very much appreciate you and your time. Before we talk about you, I got an email yesterday from somebody in your group. I understand you guys are going to host a conference here soon in Phoenix. Can you talk a little bit about that first?
So we have decided as Vertical Street Ventures, we're going to host a national conference in June 4th and 5th. It's going to be in Scottsdale, Arizona. And you were talking about why with August a minute ago, and it's purely because we want to help people understand and learn this industry, right? Spreading the gospel a bit about what does passive income look like, what does the world of real estate, multifamily syndication, and this world of you know, basically apartments look like. And so it's a 2-day conference. First day is going to be speakers and helping people get settled and understand the foundation of it. And the second day is going to be mostly a bus tour. So we're going to take them around to 5 of our properties around the Phoenix metro area, smaller, 30, 40 unit size up to over 100, you know, and so a lot of great value. You know, it's going to be a great conference. We're excited to have it. So
all right.
So if you can find out more, it's vsvcon.com if you want to learn more about it.
All right. And we'll put the link in the show notes, and this episode is going to air in plenty of time for people to grab their tickets. And I didn't buy tickets yesterday. I was this close, but the ticket price, just for everybody, is very reasonable. Are you guys still in the early bird phase?
We are in the early bird phase through March 25th. It's $99 for admission for regular admission, and then $250 for VIP. So early bird, you know, prices are up until March 25th. So
all right, and I'll be getting a VIP ticket before March 25th, probably before the end of the day today. But
love that. Thank you, Brian.
Yeah, I'll be excited to see you guys down there.
Absolutely.
So, all right. So that, you know, that was a little I wanted to learn a little bit more about that. So a little bit of you know, selfish question there, but so that said, you know, tell us a little bit about yourself, you know, what your background is and how you got into the real estate space.
Yeah, thanks, Brian. So hey, I've worked previously in my life before real estate. I worked at Procter & Gamble along with my wife. We met as interns there, but I worked there for 15 years. You know, I worked on big brands like Bounty, Charmin, and Puffs. Loved that business, loved P&G, loved working for that company. Can't say enough about it. But we relocated to Southern California recently due to family reasons, and we'll talk about why in a second. But that was, you know, and as a result of that, we had to look back at our careers and say, how do we have a flourishing career in the location that we wanted? And so with that, we made a choice where Jenny decided to leave P&G and, you know, start up her career in multifamily, and I stayed at P&G. And so since then, Vertical Street, that she started about 13 months ago, Vertical Street, basically by the end of March, we'll have purchased around 13 properties, about a $240 million worth of property value, assets under management in our portfolio. So VSV has got great, you know, great leadership and a lot of seasoned veterans in terms of managing partners. And I'm on it here to learn from August because I just left my job 5 months ago. You know, so we have had a couple raises. I've been learning the ropes. I've done 2 raises recently, but I'm always here to learn. And honestly, that's how all of us learn multi-fam. There is no formal education. You can't go to school for it. And this whole process is a discovery phase for many of us. And so,
Yeah.
yeah, it's been a whirlwind. It's been a ton of fun, and I've learned a lot the last couple months.
Yeah. As I said at the beginning, that's super impressive for me that, you come on as the aspiring investor. And incidentally, Jenny did the same thing. If I remember right, she had the first deal under contract and about ready to close it. And she also came on first as an aspiring investor to talk, to learn from people who were, several steps ahead. So, very admirable quality. And, once again, thanks for being on the show again.
Yeah, no, I'm excited
Yeah.
to be here. So thank you.
Cool. All right. So now we'll talk a little bit about your big burning why. And I know you alluded to it a little bit earlier, but let's distill that down and talk about, your motivation.
Yeah, I think it's twofold. I think one, I'm a son of an immigrant, and so the world of basically being unable to control your own destiny is very challenging, right?
Mhm.
And so I've seen my dad go through being a janitor to trying to start his own business to basically struggling through life, and basically pouring all his knowledge and resources into his kids, right? And so
Mhm.
I think what was interesting was I've been trained to become basically a very steady corporate America employee,
Mhm.
right? And so for me to leave, the reason for that was very simply I wanted to be able to control my own destiny on behalf, frankly, for my dad. My dad, the reason why we moved back to Southern California is because my dad got lung cancer a couple of years ago, and thank God he's cancer free now. But at the time, you're making decisions to say, how do I spend more time with my family, right?
Mhm.
And so that was the key driver behind thinking about what are the various ways to, like I said, create a, a life for my family, and how do we think about that? So number one, that is one of my whys. The
Yeah.
second piece, and I love what August said earlier, was how do you create great communities or people who are looking for just a wonderful place to live, right? And coming from Southern California, I know how challenging it can be, right? As August, you come from Canada, right? It's like the real estate world is such a, to be honest, it's cruel sometimes how you cannot find a great place to live because you've been priced out of the market. And so we invest mostly in Arizona. It's still a very affordable place to live, and we create great communities that provide a service that just create a quality of life that is frankly not able to be found in certain places of the country. And so that coupled with, to your point, the passive investors that come along, they realize passive income that create financial freedom for them or flexibility. The combination of those two is such a unique thing that is a wonderful world of this multifamily syndication that creates benefits on both sides of the coin for a property.
Yeah, I love it. You a lot of goodness there, and I think you touched on something that's near and dear to my heart. I mean, I wasn't corporate America, but I stayed in the military a lot because of the stability it provided.
Absolutely.
The ability to provide for your family, and
Right.
I think at some point I saw the same thing you did, where there's limitations. There's
Yep.
definite pros to having a good stable job, but at some point, I saw the limitations that, the system had and needed to break out. So
Yep.
as my good friend Jerome would said, I took the red pill eventually. But anyway, that said, Ronnie, we got August on the line. What do you want to ask him?
Before you get into it, man, I gotta say, I've talked to one of your partners, Kyle Mitchell, and he's been on our show actually. So you have a strong team there. We've even been in conversation, doing deals together. So I feel like she should be asking some questions from you. So I might end up asking some questions from you. So go ahead, brother.
No,
They have a
absolutely.
dream team assembled. I mean, they really do. I mean, it's they've got really solid people in every role. And yeah, I mean, when I heard Kyle was joining up, I was just like, man, I mean, they were good already, and now they're just even better. But anyway,
really kind words. Thank you guys very much. And I guess there's always room to learn, right? And August, I loved your story and appreciate you sharing. I mean, the partnerships you've had. I think my first question is, as you think about, you've created a great brand, you've got tons of followers, investors that come along. When you guys started scaling, what was the first aspect that you guys scaled? Who was your first hire, I guess, when you guys first started?
Okay, so maybe I can answer it in a few different ways. I mean, first thing was realizing virtual assistants that even they existed, and you
Yeah.
could hire somebody overseas and who
Yeah.
had expertise in a certain field. So that was a huge benefit for us, having contractors from all over the world, and then learning what contractors are good for what. From the regions they come from. Eastern Europeans are really good with graphic design and web development and the technical side of it. And then other regions great for other items. So that was one part. And then internally within our company as well. So when we initially started, I was dealing with investors. I was the head of investor relations. But when my partnership started with my partner, we realized that she fit that part much better than I did. And she came on, Eva Benesaki came on and took over the investor relations. And it organically happened. And that was a very interesting part of our business, really that. And now she's head of investor relations. That's basically our onboarding part of their onboarding process. So
Got it.
yeah.
That's helpful. And then speaking of that, then that actually leads well into my next question. So at Vertical Street, there's 4 of us. As you said, Kyle does mostly acquisitions. Steve and I do a lot of capital markets and marketing, and Jenny does a lot of asset management these days. So we're a bit more siloed. So my questions around capital raising, as you work with people who invest, what is it? And you've kind of mentioned this. What is it that keeps them coming back to CPI? What are the aspects of how you communicate? What are the elements that make them attractive to you guys and returning customers, I guess?
Yeah, I think it's a very hands-on experience. I mean, the exempt market, the market we're in, the real estate private equity space, the syndication space, it is somewhat hands-on unless it gets a much larger company. So people are dealing with principals in most cases, where you don't have that in the equities or other types of investment REITs and what have you. You're not sure what you're investing in or who's handling your funds. Where with us, you're dealing with, in our case, with our CEO, who's Eva Benesaki. That's the head of our investor relations as well. So that's been a big part. And a lot of times, because of the brand we've created, investors get on a call and they're like, she's like, Ava's speaking, and they're like, oh, Ava. They're shocked that it's actually her on the call with them. So that's been a big part. We do have a bit of a monopoly here in Canada because the product we offer to U.S. multifamily is so much superior to other products here in Canada. Preferred returns are another very important part of our business. Starting out, our plan is to have preferred returns as long as the market allows preferred returns to exist. So that's another thing that sets us apart from other companies. And understanding really the investor profile, the investor psychology of what are they looking for, and allowing them to kind of speak their part. At times, it feels like that there might be you play that therapist kind of role when you're talking to an investor, and
That's right.
and figuring out what are their pain points. How can your investment, how can your product relieve them from their pain points? So it's focusing on that, allowing them to explain it. So it's been a great process, man.
Yeah, and I love that, because I think that's the people usually when they schedule time with us, it's usually like, tell us about your company. Well, first tell me about what you want, right? Are you looking for passive income? Are you looking to build your wealth? Are you looking for a certain market to invest in? Tell me what you want, because I may not be a good fit for you, right? Based on the profile of deal that we can provide, right? So I love your approach there. That's awesome.
Yeah.
I think the other thing around, you talked about working with different GPs, right? And we're mostly operators, and we do most of our deals ourselves. We do partner with other GPs, usually on like if a deal is a large deal, it's usually on the capital raising we might need some help on. What are the aspects of general partners you look for on your end that you're trying to find out that say, hey, that's maybe a good GP to work with?
Yeah, no, great question. So again, because of the initially starting out, that wasn't the case. I was open to my kind of profile was much broader as far as what GP I was looking to invest with. But as we were getting approached by so many different GPs and deals coming, we got much more selective. So we look for a GP that has at least of $100 million of assets under management, their own assets, not a co-GP structure. We look for people who've done deals that have gone through his full cycle. It's very important to us. Their transparency is extremely important. The questions we ask: can we talk to some investors who invested with you? Other questions: have you ever lost money? Who is on the GP side in the past? What other GPs have you worked with in this co-GP structure? So transparency is very important for us. And it's gut feeling. I mean, in business, a lot of time I use my gut feeling. I've been in business for a long time. It's the feelings you get from someone. So a combination of all of those items.
Yeah, I think the gut feeling is interesting because it's so like there is no formal way of, with when you're working for a company, it's like, oh, you have this umbrella of that company. Everyone's been vetted, interviewed, and whatnot. This world is all about, can I get a gut feel for, is this person going to be a good partner to work with, right? It's very hard to say. Not everyone walks around with a background check on their forehead, right? So it's it's your gut feel is critical here. Yeah, for sure.
Now, August, if I can ask a follow-on question, how much does market matter? I mean, you talked a lot about vetting the sponsors. How much emphasis do you guys play on the specific market in general?
Frankly, starts with the market.
Mm-hmm.
So we're very bullish on the some states, again, because of the fundamentals that exist there. A lot of people are moving out of California, New York into these Sunbelt states. The lower cost of living, the more business-friendly laws. We look for four main metrics. We look for job growth, population growth, income growth, and rent growth. And as long as those metrics have been in place for last couple of years, that is a strong market to be in. So a very important part of our business here in real estate private equity is lowering risk. It's all about risk, right? So you can't predict the future. We're not sure what's going to happen. It's just lowering those risks that exist. And as long as you invest in such a market, there might be a black swan event, or there might be a downturn in the market, but long term you're in a good place because it has those fundamentals of job growth, population growth, income growth, and rent growth.
All right. I like it.
I have a question.
Ronnie, I still stole a little bit of your thunder. Back to you.
I have a question from Ronnie, though. I have a question.
Yeah.
Hey, Ronnie, I was just going to ask you because, your team, like Brian and I both talked about, the superstar team members that you guys have working there, and your wife has been on the show. So, there's a bit of competition between us. I got to ask my wife to be on the show here as well and see who gets more views. But aside from that, I just want to know, you mentioned that each one of you guys has a position that they play within the company. How did you guys come up with that? Did it happen organically the way ours did, or was it set that, hey, this is the part of the, this is the department we're looking after, and we're looking for someone to come into acquisitions, and Kyle comes in? How did all of that take place?
That's a great question. I think there's twofold. One would be, what are you passionate, interested in, right? Because we know when you're small, you're wearing all the hats, right? And so you'll find out, like, hey, what is it that you are interested in and passionate about? And then over time, we almost gravitated towards our roles. Kyle, the reason why he joined our team was Kyle is great at everything, but he lives in Phoenix. He loves working with brokers. He loves underwriting. He goes, I want to stick to that. He obviously had his own podcast at the time. That's the Vertical Street podcast. He did a lot of things just to be very good at what he does. But over time, we gravitated towards what we were naturally good at, and frankly, the geography of it, right? Jenny, Steve, and I were all in Southern California, but a lot of things we do are very remote. Kyle, he's got to be a boots on the ground, really execute. And if you get a deal, you got to be able to be there the next hour to see this deal scope out, right? And so I think there's a bit of natural gravitation with, just the geographical, situation we've got.
Awesome.
Yeah.
Well, we are about out of time here. So once again, thanks to both of you for coming on the show. And I got one question for each of you to wrap things up. August, you get to go first. How can listeners learn more about you?
Yeah, great. No, we really appreciate you having us. The best way to get in touch with me is our website, cpicapital.ca. We're in the process of purchasing the .com. We're having some difficulties there. And I'm very active on LinkedIn. I have a newsletter on LinkedIn that have over 4,000 subscribers to my newsletter. So August Biniaz on LinkedIn. You also search CPI Capital on LinkedIn. I'm sure it pops up. So those are the best ways to get in touch with me.
All right. And we'll put links to those in the show notes. So anybody interested in reaching out, just tap, swipe, and tap, and that internet thing will whisk you away. All right, Ronnie, same question for you. How can listeners learn more about you?
Absolutely. Thank you, Brian, first of all, once again, for having me on. So you can find us at verticalstreetventures.com. You can email me, Ronnie, at verticalstreetventures.com. Also, Ronnie Gou on LinkedIn as well. So pleasure to be here. Thank you so much, Brian.
All right, thank you. And that's a wrap. Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.